Hey, hello guys. Thank you for so much for taking the time to join us. So in this webinar, we'll be looking at you know a big part of what your retirement is going to be based on out of Australia. So we are going to be looking at your super in a lot more detail. So we'll talk a little bit more about the intricate details of the super and what most people miss out. So just as a background, at ithought we kind of manage wealth and we've been doing it for the last 15 years. This is a niche where what we found out was that the super in Australia was not really doing well, or after even decades of contributions and consistent investments, the super wasn't really delivering. So through the self-managed super route that most of you might be already aware of, we've kind of devised a way through one of our consultants there who's helping us kind of route the investments into more better growth opportunities that we have available through Indian equities in India. So I'll kind of take you guys through it, and I'm more than happy to answer any questions or things that you guys have. We already have a process in place as well as we have a lot of clients who have been doing it with us as well. So this is not something that's new. This is established and it's been going on for the last half a decade. Now, going on. Let's look at usually how kind of an Australian's super works. Now, let's say someone as an NRI or Indian origin Australian moves to Australia to kind of earn a better pay. Let's say at 40, 47, he had accumulated around $100,000 in his super and continues to contribute $10,000 every year. After a period of 20 years, he would have invested around $300,000 in his super, and his super would have grown to around 480K. That is what a conservative estimate looks like. Now, one thing that is not factored by most people is there are annual expenses, there are super charges, the insurance that is tagged with the super is also there. And taking all of this into account, and after factoring in things like inflation and medical costs, his savings would last barely for 10 years. What this forces Raj to come back to work, not by choice, but by necessity. This is one common theme that we have looked at with almost all of our super clients, where they put in so much money into their super, but when they actually take a look at their super statement, it has grown maybe at 3%, 4% per annum. Now, even in an economy like Australia, where your inflation is maybe 6, 7%, or maybe slightly lower, 3 or 4% is never going to cut it. So it maybe forces people to kind of come back. It doesn't do justification for all the years of hard work that you put in. 20, 30 years of work that is not compounding well. Now, what is the problem with it? Why is this not, why is the super in Australia not delivering what it is supposed to, or why is it underperforming so much? Now, there are a lot of factors, but before we move on, let's just look at just a kind of an explanation of this case study. Now, putting this more into numbers so that it becomes a lot more clearer. Let's say someone starts with a $100,000 balance in super and a $10,000 contribution. Over a period of 10 years, they would have put in somewhere between $200,000 to $220,000. Now, your Australian super would have barely grown to 250 or 260K. Now, if this is put into a better managed product, let's say Indian equities for this matter, now you can see where the compounding takes into effect. There is a huge difference. And this is not a difference that is an approximate difference. This is the difference that we've seen over the last 4 or 5 years, where if that money had already stayed in super for those clients, it had barely moved at 3-4% per annum. But with Indian equities, even assuming a very, very conservative rate of, let's say, 10-12%, you're still doing a lot more. Let's say Indian equities or a specific portfolio manages to 15% or 16%. Then you're looking at a much wider alpha than what you would have earned. Now, keeping in mind, this is your retirement money that is locked in until 60 years. Now, some justification has to be done for it so that it has a long horizon. So let's say a 20-year period, or maybe even a 30-year period for it to grow. And let's say your preservation age or your retirement age is 65, and it's still longer. So why not put it into better managed equities or better managed funds? Because anyway, this money is going to be locked in. Anyway, you're not going to touch it. Anyway, this $10,000 or a higher contribution of your pay is keep going in. Now, one thing people need to look at it is that what super that is managed in Australia, or the super funds that are recommended there, they have a lot of transparency issues. There is no lack, there's a very big lack of transparency that is going on. Whatever is shown in your super statement is not what is happening there. And a lot of what returns that are shown, what we've looked at is that this is before fees, charges, and taxes and things like that. Now, whatever we want to show you is always after these things so that it is all well taken care of. Now, imagine over a 20-year period, you had put in $300,000 of your hard-earned money. Your Australian super only compounds to 480K. Now, that 480K is not enough for your retirement. At least you need to have $1 million corpus in hand, maybe even more. That is what ideally we should be going for. With this being managed in a proper and a responsible way, so that you have proper transparency and consistency of where your investments are doing, going in, and you also have a rationale behind those, because these things are very, very important. And you need to have a point of contact who will let you know why certain investments are being done. Now look at the difference over a 20-year period. There's almost a $1.8 million difference. Now that $1.8 million, let's say it compounds for another 5 years, 6 years, that might double to $3 million. So this is what your super is supposed to do. This is what actually your Australian super is supposed to do, but it is not doing it because the management of the Australian super there is very cumbersome and is not done in a proper way. This is the problem statement, and this is what we want to address it. We've seen a lot of our own clients where they've accumulated $400,000-$500,000 in super over a period of 20 years. Doctors, miners, IT professionals, teachers. These people have put in a lot of work to accumulate it, but super has barely moved. So that is the problem statement that we are going to be addressing. Moving on. Now, just a little bit of background on what is super. Super is Australia's mandatory retirement savings system. This is contributed by employers. It's structured, regulated, and designed for long-term growth. Now, what is the problem with it? Most investors don't have full visibility into where their money is actually invested or what is actually happening inside a super. So I kind of ask you to go and look at your super statement, look at where your money is going into account, because even though a larger share may be in equities, the exact holdings or performance drivers aren't very clear, making things very harder to know what's really working for you. And the worst part is whatever is being shown on your super statement is not what is actually happening. I'm just going to present something for you guys. This is how a super statement looks like. You guys will be very aware of it. Now, if you can see the pie chart, there are a lot of different things that are going on. You have international shares, you have alternatives, you have Australian shares, you have cash, you have fixed income. So all of these form a part of your super. Now, one thing to take a note is that your super kind of invests a little bit of money into all of those. Now, further details on what kind of shares they hold or what kind of cash they hold or what property that they're investing in is not visible or it is not available very publicly. Over $4.1 trillion sits here. Many Australians, age 65 to 70, they continue to work. We have people who went back to work. What is the problem here? Because your default super plans, they have no transparency. They have no flexibility. They'll take a life cycle based approach where over a 20-year period, I don't need to have cash or fixed income as 20% of my portfolio because this will automatically pull down my returns. I need to have a very structured approach so that as and when you near retirement, your asset allocation is taken care by your own needs and not left to some mandatory arbitrage rate or some mandatory kind of limit where it is being managed superficially. So we have to take control of it so that in the initial years, we're able to do much better. And when you get closer to your retirements, you're able to de-risk it, but at the same time, account for growth as well. This is what super needs to do. This is what every single retirement plan needs to do. You take your US 401ks, you take your Indian national pension schemes. All of these cater to this aspect, and this is what they should do so that you guys have a very comfortable retirement. Even if you guys need to, make a larger ticket purchase in retirement, your super should allow it. Now, coming back to the problem, you see your balance grow each year, but rarely know why. So, you're contributing, you're putting in money, but, where is the growth coming from? If at all there is any growth, where is it coming from? Most supers usually claim to invest smartly. They say there are some algorithms and stuff in place, but there's no details aren't visible and the results don't show for it. 3-4% growth over a 7-8 year period doesn't really do justification to your retirement corpus. Now, coming back to certain things like real estate, even areas like real estate exposure that is taken inside your super through a fund, they haven't quite met long-term expectation because there is a large divergence between how your real estate has done in Sydney or Melbourne versus how it is being done inside your super. It's really hard to tell which parts of money are truly working for you. Now, this creates the question, will my super really last me post-retirement? Let's say there's a very big medical bill post-retirement, or let's say there is a lifestyle inflation that is above far and beyond what you guys are currently withdrawing. Your super will not last you until then. And all of this after a 20-year, 30-year career is definitely not what you guys should be looking at. You guys have done the work. Your super should do the rest of the job. Now, thankfully, there is a way to do it. That is your self-managed super fund or your SMSF. Your SMSF is just a vehicle. Your SMSF doesn't decide where you put your money in. That is where an advisor comes into place. An SMSF gives you full decision-making power of what you do with your super, how you control it. Most people know that this is there. Some people don't know that this exists, but there's still some operational kind of inconsistency on how to do it. This gives you the full control of how your super is invested, both locally as well as globally. Now, if you combine you and your spouse's balances under one structure, let's say a 200K, a 400K, a 500K balance, this gives you the opportunity to invest over the next decade or a half using better performing structured instruments. Building a portfolio that matches your goals, values, as well as your long-term vision. Let's say after 60 or after 55, you want to take a break. You want to make sure that you've worked enough. Whatever you've accumulated till now will last you for 5-6 years from now, and then your super takes over. That is where an SMSF comes in, where you structure it now itself so that it is okay, it is in place, and you invest in better quality instruments that give you the long-term growth that you're looking for. Now, SMSF is a way for us to address the problem, but there is one more problem that exists. We have to rethink the property mindset because Australia is a real estate heavy market. Just to address it in a small fashion, property has long been Australia's comfortable investment, even inside your super. Real estate through super, there's a lot of things also go into place. You have additional interest on loans, you have maintenance charges, you have slower liquidity, and imagine your additional contributions are not going into creating more wealth. They are only going into, reducing your debt. That is not how your super is should be structured. Your super should be structured for long-term growth in the best possible instrument so that you have a couple of $1 million or more at retirement to do whatever you want. You worked hard, and that is what your super should afford you. But property doesn't really give you that flexibility. What we've seen is the property market usually doubled every 10 to 12 years, maybe slightly lower. Indian equities as a product have historically doubled even 5-6 years. Let's say conservatively speaking, they even double every 7-8 years. You're still looking at a 5-6 year alpha. And over a 30-year period, this adds up. So you'll be able to double your money, let's say 3 or 4 times. And that creates that $2 or $3 million corpus that you guys deserve. One more thing that we looked at when we analyzed a lot of super statements is that don't be misled by the pre-tax, pre-fee returns shown in your super statement. I will show you, I will give you guys a spreadsheet where we've kind of taken all of the, the taxes, all of the fees, the insurance, all of these into account and then calculated the returns. Use this into account. I'll give you guys the Excel at the end of the sheet. You guys will be, you guys will be taken back by what your super is doing and what is there. So there's a wide divergence between what is presented on the statement versus what your super is actually doing in hand. So these are things that you guys need to know, because even if you don't go for an SMSF route, your super still needs to earn you a better rate of return. An SMSF is just a tool for you to do that. Now, using that tool and properly using that tool is the next thing that we'll be looking at. How do you properly use that tool? This is where the power of compounding through Indian equities comes into place. Again, just a very small example on someone who's been doing it with us as well. These are all approx numbers. Total contribution around 440K. Typical super has done somewhere between 3-4%. I've taken a slightly higher rate here as well. This is assuming you start with a 200,000 balance and you put in a monthly balance of 200,000 Australian, 2,000 Australian dollars. Typical super comes somewhere between 650K to 700K. These are numbers that we've actually observed. The same in, let's say, a managed equity portfolio that takes lesser return. You have full transparency that comes with lower fees, maintenance charges. All of this does somewhere between 1.4 to 1.5 million dollars. In 10 years, you've already done more than what your super does. In 20 years' time, you're looking at a much bigger corpus than what your super is even capable of. If you look at the line graph, you can see the sharp divergence between what the super can do. These are all historical returns that we've taken for the super versus what a properly managed Indian equity portfolio in a developing market can do. Now, most people have the consideration that property, I'll just put it, I'll use my super, I'll put it in property, it will do more. Property has a lot of fees and charges, as well as the mortgage rate is also higher. And most people, what they do is they apportion a part of their super only towards this so that, their debt goes down. But property doubles every 10, 12 years. That is not enough. Usual working career is somewhere between, let's say, 25 to 30 years. So ideally, you would only double thrice, if not. But Indian equities gives you the option to, double, maybe, 6 or 7 times so that your retirement is safe. Why do Indian equities? Why not any other markets? Because with super, the SMSF kind of allows you to take anywhere, right? Now, India is a very strong economy that is growing steadily at 6-7% per year. That is the GDP growth. That is what India is growing at. Nifty 50 is like your ASX in Australia, just like the ASX 200. Nifty 50 is India's standard index. Just the index, no other products, just the index has delivered close to 12 to 13% annualized return over the last decade. This is what it is poised to do over the next decade as well. This growth is powered by very strong corporate earnings, a young workforce, and very favorable demographics, with people in the age group of 20 to 30 dominating India's demographic. This coupled with a very, very big and growing capital market culture in India, as well as a lot of foreign institutional money that is also coming into India. We have transparent markets, high liquidity, making it a very compelling long-term growth opportunity. One consideration that even our existing super clients have is the AUD INR. What happens if you guys make good money, but let's say the Australian dollar depreciates. We looked at the last 15 years data. AUD INR has remained completely stable. It's gone from 55 to 57 and back to 55. So it has remained in this range. I'm taking it an average. Sometimes it has gone slightly below 50 or sometimes slightly higher. But a currency like this, which has remained largely stable, gives us even a better kind of return push, because your currency has not done much. It's remained completely stable against some things like the US dollars, which has completely appreciated. So in this context, your currency has not done much. So there's not a lot to worry about it. So Indian equities, you can just look at it as a separate factor of returns. That is what Indian equities offer you. Now, Indian equities, when done in a structured manner, when you take calls on how to manage it in a better way, they have the probability to do a lot more. So that is where doubling your capital every 5 or 6 years comes into place. These are not arbitrary numbers. These are things that we've done for the last 10 years, done for the last 5 years, even for our own super clients. A little bit on the operational part. I won't go too much into it because these are things that we've already done. We have someone who is helping us with the SMSF setup in Australia, who have simplified the process for us so that, all questions and stuff, they are able to answer it. This person, Mr. Prabhu, is able to answer it. So for us, this is more of a thing where managing Indian investments and making sure that your process is smooth, both on the Australian side as well as the Indian side. Since we've already done it as well, there is some sort of a smooth process in place so that you guys don't need to break your head over the operational complexities. Just running through it, we set up a SMSF in Australia as a trust. You guys become the joint holders and trustees of your super. You guys need to have a NRE account in India so that you can freely repatriate funds between India and your country of origin, which is Australia. There is no limitations. There is no taxes or stuff. You can take money in and out of India as and when you want. You can transfer your funds from your trust account to an NRE account. And from an NRE account, we will invest it in either, a managed portfolios or a separate portfolio that is constructed for you, and manage it in a very disciplined and structured manner with complete transparency. You will get monthly reports. You will get an online login to see how much your investments have grown, as well as rationale from us and our fund management team on why a certain idea is being picked, why a certain fund is being picked, what is the investment rationale behind it, how long do you guys plan to hold it? Because when someone manages your portfolio, these are things that are mandatorily that should be available, not left to chance. And of course, tracking and reviewing the performance while your SMSF stays fully compliant with both regulations. So we have all, since we already have this in place, I'm just running through this, but I'm more than happy to kind of take more questions on it in a more one-to-one fashion, so that we can answer all of your questions and put you guys at ease as well. So this is something, this is ongoing. We have people who are audit compliant as well, ATO compliant as well. So you guys don't need to worry about it. This is taken care in Australia itself. Now, why do we stand out versus Australian Super? I have someone from my investment team who will kind of take it from here. What puts us apart? What puts ithought apart? Why do you need to invest with ithought? Because your SMSF can go anywhere, right? It can go anywhere in India. So why do you need to do it with ithought, or why? What is ithought's edge? So I have Mr. Hushel with me. He's the investment strategist. He'll kind of take us through the investment part of the webinar.
Hey, thanks, Nakul. Let me just switch on my camera. I think there's an issue. But I'll take you through why we stand out versus that of the Australian Super. First point is that everything that we do here is completely bottom up. Everything is research driven. Everything is strategic. Nothing is being taken just for the sake of it. There's no generic fund allocation. There is everything that we do is completely tailor made to your needs. Right? So every portfolio that we manage will be completely different, and everything will be solution oriented. Right? We do take an active risk management approach across all asset classes and geographies. So we don't just stick to equities alone. We do a lot of multi-asset investing, which means that we do take an active debt call. We do take an active precious metal call. We do take outlier global calls as well, which are completely tactical and are high conviction in nature. Right? And it is a flexible mandate. So it can go from 0 to 100. Right? We don't have a set mandate to say 10% or 20% has to go into this particular geography or this particular precious metal, but it is completely flexible. And as Nakul was pointing out, I think the problem is that you don't know where your money is going. But here, everything is clearly visible. All our decisions are made one-on-one, where we discuss with you completely. So there will not be any opaque fund structures. Everything will be shown to you. Everything will be transparent completely in nature. You will get monthly reports from our side. You will have one-on-one discussion straight away with the team and with the fund management team. So there is no wall between you and us. Right? Our goal is very, very simple. It is to help you retire confidence, knowing your super is managed very, very smartly. So we are not leaving it up to chance for some particular market to suddenly deliver returns, or for Australia to suddenly grow at 6-7% GDP and interest rates working in your favor, where earnings growth come in for those businesses listed in Australia. There's nothing like that. Everything here is completely research oriented. Okay, so our philosophy again is very, very simple. We do contrarian investing. We have a bottom-up approach, and we are value oriented, right? Which means that we will not do what the market is doing just for the sake of doing it, but we will be against the market in terms of having a mind of our own and having a view of our own, which again will be more bottom up in nature, with the focus of more than 5 to 7 years. So every decision that we will look to take is going to be made on the long-term future. So I'll give you one example of our investment philosophy. Like I said, we follow a multi-asset approach. So we had taken a very bold stance on gold and silver back in 2018, and we had invested almost 20% on our books, right? And for all our investors, right? Given the fact that everybody has a 7-year plus, 10-year plus sort of a horizon, that is what that is a call that we had taken in 2018 and continuously kept maintaining that particular call, which means that if the weight would go down, we would increase the weight back up. If the weights were started off lower, which is why I said that every portfolio we built is different. So if somebody came on today versus somebody who came on 6 months back, their portfolio weights would be different. So 5% or 10%, right? To match that weight, to make sure that you're having the right amount of weight. So that level of portfolio optimization is what we do for every individual portfolio that we manage, right? So such a call actually worked out for us now. So for 8 years, our investors are actually benefiting from such a move in gold and silver. So that is the type of contrarian investing that I'm talking about. And we follow that across asset classes, across geographies as well. So we had taken a US exposure call back in 2021 in terms of that tech, and again benefited us all the way up until 2024. Right. So let me get into our philosophy of strong fundamentals plus attractive valuations. We always look and hunt for those businesses that have very high and good corporate governance. Basically want to invest only with market leaders. So they will be somewhere between the first, second, or third rank, because the industry size itself will be small and poised to grow. So they will be industry leaders and they will be top of the mark in terms of their metrics. Like, most importantly, we look to partner with those businesses where they have zero or low leverage. That is the philosophy that we follow. This philosophy is iterated across all our strategies on the PMS and on the mutual fund part. So we have, so I think Nakul, once you go there, I'll take you through all the strategies that we manage as well. And naturally, reasonable valuations is what we are looking for. We have a range of fair, cheap, cheaper, fair, expensive, very expensive. So staggered in and staggered out is the approach that we will look to follow. Coming to our strategy, this is our flagship PMS. This is designed for steady and patient wealth creation. This is a 100% equity product. Again, it is a multi-cap portfolio in nature, which invests in businesses with strong governance, leadership, and growth potential. This is the strategy in which we are very strict in terms of not having businesses with high leverage, which means high debt profiles. Right? Our focus here is completely bottom up. So here you will not find overlaps with the benchmark in terms of if you compare us to other mutual fund and other PMSs as well. So if you look at our fact sheet, if you see current weights where we are having a high weight on is auto, is financial services. So banks usually do not come here because their businesses are more lending in nature, so which means leverage, but we have that exposure towards financial services. Then comes FMCG, which is our top weight 21. So top three is FMCG, auto, and financial services. We do have some weight on the capital goods part, and other businesses are where we are looking to scale up. So this strategy can easily shift between mid, smalls, and large. So since our inception, we were running at a small and mid cap sort of a allocation since 2019, and today now we are transiting more towards large cap, not compromising on the quality of the businesses that we invest in. And if you look at our returns, in terms of inception returns, we have been compounding at 22.5%. So these are very, very good returns given the fact that our risk management has worked in favor of us and the markets also have rewarded us favorably. Our second strategy is a very, very clean large cap portfolio. This is basically, it is like a premium product where we have the core philosophy to be elimination, where we don't take too much of risk and only those creamy layer of large caps within the Nifty 50, the universe will be Nifty 50, is what we will look to invest in. Here, the concentration of portfolios will be very high because we do have a very small universe to work with. So it will be a very concentrated and focused portfolio where our ability to take risk will be on the concentration levels and not on the businesses, since these are all top of the notch businesses that we will be investing in. So if you see Nifty 50 has a weight of 36.5% on the banking and the financial services part, but on True Blue, it is 43%. So here we are looking to play a little outside the crease to hit a 6 out of the park, right? Likewise for auto, it's almost double the weight of that of Nifty. So here you will clearly be able to see all our outsized bets and concentrated calls, but making sure that the quality again is not compromised, since we are investing in top of the notch businesses with very, very strong fundamentals and metrics. In terms of Neo is our multi-asset strategy. It is an all-weather strategy. This is the strategy that allows us to be very, very flexible in terms of asset classes, where we can go 0 to 100 in either equity, debt, global, and precious metals. Right? So we don't have any cap, and we are able to take global decisions from India and precious metal decisions from India via ETFs. So here it will be a mix of top down and bottom up, since we do have good amount of exposure that will be on the global part as well. So it will be a mix of top down and bottom up approach. So 360-degree investing is the process that we follow. So if you see here in terms of our asset allocation, if you see 15% continues to be right now on precious metals. But interestingly, since I am part of that particular strategy, for us, debt as a weight since our inception was sub 2%. Today, as a strategy, we are crossing 5.5%. But portfolios that we manage and that we have built over the last 1 year, their weights are significantly higher than 5.5%. So what you're seeing as this number is an aggregate weight. But portfolios that we manage definitely have outsized weights beyond that of our aggregated weights for new. In terms of our equity strategy, again, the process is very, very simple. We do look at only large cap businesses, majorly large cap businesses. Here we can take a slightly higher call on leverage, since we do have other parts of the portfolio that are a hedge and are tactical in nature. So banks are a big weight here. Financial services again are a big weight for. So if you see both combined together, still we are somewhere around the Nifty range, but a little below. But still playing a little outside the grease. Consumption again is a high weight for us. Auto again is a high weight for us. Predominantly, this strategy will be more large cap on the equity part, but we will be following the multi-asset approach here. Our other strategy is for all aggressive investors. This is a pure, fundamentally driven small cap strategy, where here it is like a private equity fund, since not a lot of information is available on the small cap part when we invest in small caps in India. Information again is not very widely available. Now things are changing, but this is a strategy that does deep due diligence, has a very, very disciplined approach in terms of valuation. So for example, today on day one, in Neo, we are deploying about 55% on day one. So if you give us the money, 55% gets deployed today. Everything else is going staggered depending on how valuation and ranges behave. But Vriddhi is much, much more stricter in terms of valuation, because they have to get the capital allocation extremely right for small caps. So their allocation will be far, far lower than that of us. And they will try to hit it out of the park when valuations are in range between cheap and cheaper. Right. So if you see in that strategy, the overweights there are on the agrochemical side. So like I said, contrarian and bottom up. So here completely different from the small cap funds that are being managed here in India, which will have an overweight towards financial services and banks, and then comes capital goods. But here our portfolio is completely contrarian, where agrochemical, real estate, chemicals, and infra are heavyweights. Okay, here we take advantage of every opportunity that is presented to us, one by way of market and second by way of interacting with you, because everything here is tailor-made. So opportunities again we will be able to capture based on every contribution that you are able to make. Like your super compounds over time. I'll also put in Nakul. Nakul, if you do have any points, please do take it over.
So one good thing about what we presented was every single thing that you see is after all fees and charges. So there is nothing that is, you need to pay extra on top of that. So this is one place where, you get the kind of transparency that is being promised, so that what you see is what you get. And if it says 22%, that means that's a 22% return year on year over the last 4 or 5 years since the product was started. This is what ideally your super needs to do, but it is not doing. So, SMSF plus an Indian equities through ithought offers a killer transparency of, you get full transparency, you get disciplined and structured investing that is, for purely for long-term growth, and, better compounding than your conventional super funds. And if I may, much better compounding than what we've seen over the last 5 years. So act now. Don't let your super sit idle, because each year that it sits idle, it is eating away at your kind of growth potential. The inflation is eating away. Take control and plan for a confident retirement. Connect with us for on all of the next steps. We'll kind of guide you through the entire process of setup, so that you guys don't need to break your head over it. You guys just, you can ask us the questions. We are more than happy to kind of take it forward from there.